Most people are making a decision right now that will either build or destroy their long-term wealth. And the worst part is they are making it based on a comparison they have never actually done. Real estate versus stocks. Everyone has an opinion. Your parents say real estate. Your colleague says index funds. Your neighbour just bought a rental property and calls himself an investor. But almost nobody has ever sat down and run the real math, the full math, including every cost, every tax, every hidden number that changes the entire picture. And when you run that math honestly, the answer is not what you would expect. In fact, for the majority of people watching this right now, the right answer is the one they have been told is too boring, too slow, and too simple to actually work. Here is what the real estate crowd believes. Property always goes up. You collect rent. The bank pays for the asset with someone else's money. It feels real, tangible, something you can actually touch. And stocks feel like gambling, numbers on a screen, companies you do not understand, prices that move up and down for reasons nobody can explain. So the investor who has some money chooses real estate because it feels safer, it feels smarter, it feels like what wealthy people do. Here is the problem with that logic. Feelings are not math. And when you replace feelings with actual numbers, the picture changes dramatically. The S&P 500 has returned an average of 10.5% per year over the last 50 years. Not 5%, not 7%, 10.5%. Including every crash, including the dot-com collapse, including 2008, including COVID. Through all of it, the average annual return was 10.5%. Meanwhile, the average US home has appreciated at roughly 4.4% per year over the same period. Before maintenance costs, before property taxes, before vacancy, before the mortgage interest that almost nobody remembers to subtract. When you account for all of that, the real return on the average rental property in America is somewhere between 3% and 5% annually. That is less than half of what a simple index fund has delivered over the same time period. And yet, the conventional wisdom still points to real estate as the smarter, more sophisticated choice. By the end of this video, you will have the real numbers in front of you. And you will know exactly what to do with your money based on your own situation. So make sure to stay until the end, leave a like, and let's start. The first calculation almost nobody runs correctly is the down payment math. To buy a $400,000 rental property, you typically need a 20% down payment. That is $80,000 up front. The instinct is to think, great, I control a $400,000 asset with only $80,000. That is leverage. That is what makes real estate powerful. And the leverage part is true. But here is what gets forgotten. That $80,000 had another option. If you had put that same $80,000 into a broad market index fund in 2014 and left it alone, it would be worth approximately $220,000 today. Not because of any clever strategy, just because the market returned its historical average. Now compare that to the rental property. A $400,000 property at 4.4% annual appreciation is worth roughly $630,000 10 years later. That sounds impressive until you subtract the mortgage interest paid over 10 years, easily $120,000 or more on a standard 30-year loan. Subtract property taxes. Subtract maintenance, which averages 1% of property value per year, so another $40,000 over a decade. Subtract vacancy periods, repairs, insurance. When you do the full calculation, the actual net gain on that property over 10 years is often significantly lower than the appreciation chart suggests. The index fund, by contrast, required nothing after the initial investment. No phone calls from tenants, no emergency plumber at midnight, no property tax bill, no roof replacement. Just compounding, quietly, in the background. But here is the part of this debate that almost no one talks about honestly. And this is where the conversation gets genuinely interesting. The comparison above assumes average results. Real estate is not one market. It is thousands of local markets, each with completely different numbers. A 44-year-old electrician bought a duplex in Austin, Texas in 2017 for $310,000. He put $62,000 down, rented both units, and covered his mortgage entirely from rental income from day one. By 2024, that property was worth $590,000. His equity had gone from $62,000 to over $340,000. His tenants had paid down his mortgage for 7 years, and his rental income had increased as market rents in Austin nearly doubled over that period. That is not the average real estate story. That is what happens when someone buys the right property in the right market at the right time. The problem is that the average investor does not do that. They buy what is available near where they live. They pay too much because the market is competitive. They underestimate the carrying costs, and they end up with returns that look much closer to that 3% to 5% average than to the Austin success story. Real estate can absolutely outperform the stock market, but it requires timing, location, management skill, and capital that the typical investor simply does not have in the right combination. Now, here is where the psychology of this debate becomes more important than the math. The real estate argument is not really about returns, it is about control. When you own a rental property, you feel like you are running something. You make decisions, you can force appreciation through renovations, you can increase rents. It does not feel passive, it feels like building something. And that feeling of control has real value for certain types of people, but it also has a real cost: your time, your stress, your attention. A 29-year-old teacher put $15,000 into an S&P 500 index fund 5 years ago and has added $300 every month since. She's never thought about it, never called a plumber, never worried about a tenant leaving. Her account today sits at just over $47,000. She has contributed $33,000 of her own money, and the market has added nearly $14,000 on top. That is not a dramatic story, but it is a real one, and compounded over 30 years. That same contribution rate at the historical average return produces a portfolio worth over $650,000, without a single midnight repair call. Warren Buffett has said it more clearly than anyone. For the average investor, a low-cost index fund bought consistently over time will beat the results delivered by most professional fund managers and almost all amateur landlords. That is not an opinion. It is a mathematical reality that almost nobody in the real estate versus stocks debate is willing to say out loud. So here is the honest answer that the internet refuses to give you. Real estate wins when you have the capital, the local market knowledge, the time to manage it, and the ability to find properties that cash flow positively from day one. If all 4 of those things are true for you, real estate can be an extraordinary wealth-building tool. Stocks win when those conditions are not all present, which describes the overwhelming majority of investors watching this right now. And here is the move that actually makes the most sense. Use stocks as your primary wealth-building vehicle. Set up automatic contributions to a low-cost index fund every single month without fail. And if you build enough capital and find the right opportunity, add real estate on top of that as a second engine, not as a replacement for the first one. The biggest mistake is choosing one over the other based on what feels smarter. The smartest investors do not choose. They understand what each asset does, what it costs and what it requires, and they use both in the way that fits their actual life. Set things in motion tonight. Open your brokerage account. Set up an automatic monthly contribution to a broad index fund. Even if it starts at $100, do it before you do anything else. Because the data is clear. The market rewards consistency above everything else. Time in the market beats both timing the market and spending years searching for the perfect property, in the perfect city, at the perfect price. Start where you are. Use what you have. And let compounding do the work that most investors spend their entire lives trying to do, manually. If you have made it this far, you are already thinking differently about your money than almost everyone around you. You are someone who wants the real numbers, not the comfortable story. And I'm going to guess you have already subscribed to this channel, because this is exactly the kind of content we make every week. If you have not subscribed yet, do it now. And watch the next video on screen. We already broke down the fastest way to double your money, and it connects directly to everything you just learned here.